and promise. Imagine if a single quietly working investment vehicle could serve as the engine behind a family's wealth for generations, without the drama of stock picking or timing the market. Could one low-cost ETF really build a legacy? Today on the Capital Breakdown, we're unpacking exactly how a simple exchange-traded fund, or ETF, can be a powerful tool for long-term wealth building. By the end of this episode, you'll understand what makes ETFs so accessible, how compounding works in this context, and why patience and consistency matter more than chasing quick wins. Whether you're just starting to save or want to bring clarity to your portfolio, this breakdown will give you a solid foundation on the potential and the realities of using ETFs as a building block for generational wealth. The problem or confusion: many people think investing has to be complicated or risky to pay off. You hear stories about picking the next big stock or timing market highs and lows, and that can feel overwhelming or even discouraging. It's like trying to guess which single road will get you through a labyrinth fastest without a map. This confusion often leads folks to either avoid investing altogether or chase flashy tips and trends. Meanwhile, the idea of steady, patient growth through something simple like an ETF feels too boring or slow to matter. But in reality, the problem isn't investing. It's misunderstanding that wealth building is more about consistent habits over time than about quick wins or perfect calls. Core concept explained. Let's break down what an ETF actually is in plain English. Think of an ETF as a big basket filled with lots of different investment, fruits, stocks, bonds, or other assets, all bundled together. When you buy a share of this basket, you own a tiny piece of everything inside it. This diversification helps spread out risk, so you're not putting all your eggs in one basket. ETFs usually track an index, like the S&P 500, which represents a broad swath of the market. What makes ETFs special is that they trade like stocks on an exchange, so you can buy or sell them anytime the market is open. The key terms here are diversification, low cost, and accessibility, which combined make ETFs a practical tool for many investors. Core concept explained, continued. Now, let's talk about compounding, the secret sauce behind generational wealth. Imagine planting a tree that not only grows fruit, but also drops seeds that grow into new trees. Over time, your original tree becomes a whole orchard. In finance, compounding means your investment earnings get reinvested. So you earn returns not just on your initial money, but also on those returns themselves. With ETFs, especially ones that reinvest dividends, compounding can steadily increase your investment's value if you give it enough time. That's why consistent investing and patience are crucial ingredients. The growth might feel slow at first, but like that orchard, it can multiply surprisingly over years and decades. How it actually works behind the scenes. ETFs are managed by fund providers who assemble the basket of assets and handle the day-to-day operation. Investors like you and me buy shares through brokers, which act like marketplaces connecting buyers and sellers. Regulators oversee these markets to keep everything fair and transparent. When you invest in an ETF, your money is pooled with others and used to buy the underlying assets. The price of ETF shares fluctuates throughout the trading day based on supply and demand. Fees are a small but important part of the picture. Fund providers charge an expense ratio, which covers management costs. Even though these fees are usually low compared to mutual funds, they do slightly reduce your overall returns over time. So keeping costs minimal matters a lot. How it actually works continued. Another piece of this puzzle is liquidity, how easy it is to buy or sell your ETF shares without big price swings. Most broad market ETFs have high liquidity, meaning you can enter or exit your position smoothly. But some niche ETFs might be less liquid, which can raise risks. Also, dividends paid by the companies inside the ETF often get reinvested or paid out to investors, adding another layer to your earnings. It's important to remember that ETFs are subject to market risk. Their value can go up or down based on economic conditions, company performance, and broader market moods. Understanding these mechanics helps demystify the process and gives investors a clear picture of what's happening with their money. Simple, concrete examples. Let's look at two different scenarios. First, imagine someone who decides to invest a fixed amount every month into a broad market ETF. Think of it like regularly filling a bucket with water. Over time, even if the water flow isn't steady, the bucket fills up and can overflow in the long run. This strategy, often called dollar cost averaging, helps smooth out the bumps of market ups and downs. Now, contrast that with someone who buys a single speculative stock, hoping for a quick jump. The stock might soar or plummet, creating emotional highs and lows. While single stock picks can pay off, they carry higher risk and require more attention. These examples highlight how ETFs can provide steady exposure to the whole market, reducing the anxiety of timing or guessing winners. Simple, concrete examples continued. The monthly investor in the ETF might see the value of their investment rise gradually but steadily, benefiting from reinvested dividends and compounding returns. They're less likely to panic during market dips because their portfolio is diversified and their plan is long-term. On the other hand, the single stock trader might feel the stress of volatility more acutely, facing sharper swings in value. This emotional roller coaster can tempt people to buy high and sell low, which works against building wealth. Both approaches have their place, but understanding the differences in risk and emotional impact is key. The steady investor's journey shows how simple, disciplined investing in ETFs can quietly build wealth without the drama. Risks, traps, and common mistakes, of course. No investment is without risk. Even ETFs face market risk. If the overall market drops, so will the value of your ETF shares. Concentrating too much money in a single sector or theme ETF can increase risk, just like putting all your eggs in one basket. Leverage, like borrowing money to invest or using complex derivatives, can amplify both gains and losses and is generally not suitable for most individual investors. Another common trap is impatience, expecting quick returns and reacting emotionally to short-term market swings, often leads to selling low and missing out on rebounds. Understanding your time, horizon, and risk tolerance is essential. The real power of an ETF lies in steady, long-term commitment rather than quick speculation. Risks, traps, and common mistakes. Continued. It's also important to watch out for fees and expenses. Even small differences in cost can add up over decades and eat into your returns. Beware of chasing the latest hot ETF without understanding what's inside it. That could expose you to unexpected risks or poor diversification. Another mistake is neglecting the bigger financial picture. Investing without an emergency fund or clear goals can force you to sell at the wrong time. The takeaway: patience, education, and a well-rounded approach are your best defenses against common pitfalls. The capital breakdown encourages you to build knowledge steadily and treat investing as a marathon, not a sprint. How to think about this tool. So, where does an ETF fit into your broader financial life? Think of budgeting and building an emergency fund as your financial foundation, the sturdy base that supports everything else. Once that's in place, investing in diversified ETFs can be a smart way to pursue long-term goals like retirement or legacy building. Remember, investing is just one piece of the puzzle. It works best when aligned with your timeline, risk tolerance, and personal circumstances. Instead of chasing the next big thing, focus on disciplined saving, keeping costs low, and revisiting your plan periodically. ETFs offer a flexible, accessible way to participate in the market's growth. But they're most powerful when combined with good financial habits and realistic expectations. How to think about this tool. Continued. Also, keep in mind that your financial situation and goals might evolve over time. An ETF that made sense early on might need adjustments later as you approach different milestones or face new priorities. That's perfectly normal and part of a healthy investing mindset. The Capital Breakdowns approach is about empowering you to understand the tools available and make informed decisions, not about chasing hyper-quick profits. By thinking of ETFs as a reliable component of your financial toolkit, you can help build a foundation that supports your dreams and potentially those of future generations, all while managing risk thoughtfully. Recap and educational disclaimer. Let's recap the big ideas. First, ETFs are baskets of diversified investments that offer an accessible way to participate in the market. Second, compounding and consistent investing over time can quietly build wealth, much like growing an orchard from a single tree. Third, understanding risks, fees, and the importance of patience is crucial to avoid common pitfalls. Remember, this episode is for educational purposes only, not personalized financial advice. Everyone's situation is unique, so always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for joining us on the Capital Breakdown, where we break down money, markets, and investing so you can feel more confident steering your financial journey. Until next time, keep learning and keep growing. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.